Hey, let's get real about the real estate market and quit reading the papers, listening to the radio with the soothsayers of doom. We have one of the strongest markets that we've had in my 45 years because there's such a lack of inventory, and continuing for the next couple years, you're going to see that lack of inventory until the building catches up a little bit, and you're going to see multiple offers on those nicest listings. But you have to understand where we are with the market. But a lot of people are saying, hey, we're at 2008. Well, let me show you a couple things, and you tell me if we're at 2008. Okay, the unemployment situation. Unemployment rates at an all-time low at 3.5%. Does that sound like a recession? Mortgage debt. Mortgage debt income ratio near an all-time low at 3.9%. The lowest was 2021 at 3.5%. Does that sound like we're heading into a recession? Forbearance. Remember all the people who went into forbearance? Look at this chart. Well, it decreases a 0.44, but it's 0.44 in June. You see it steadily has gone down, and basically 35%, when you look at this pie chart, were paid in full. Almost 46% were workouts or repayment plans, 17.9% were still in trouble, and 1% lost their home. Look at this. Does this look like we're into a recession? And foreclosures. Well, this kind of speaks for itself. Look at foreclosures going down all the way to 2008, where it peaked at 1.7 million in 2010. Well, we're at 186,000. Now, you'll read the newspaper and they'll go, hey, well, foreclosures have doubled and tripled the last couple of years. Well, yes, they have, because they're based on 2021, where there was a moratorium on foreclosures, so there was hardly any. Yes, it's doubled, but look at this graph and see how far it is below. It's like half almost of what it was in 2018 and 19, which were kind of our last normal years. So delinquency rates. Delinquency rates are seriously on a decline. Look at Fannie Mae and Freddie Mac. They're almost down to nothing. Does this look like we're heading into a recession as far as real estate? Negative equity. This is one of the things I love. Look at almost 70% of the people have more than 50% equity, or their home is completely paid off. And this is, there's no way that we're going to see a foreclosure rise, because people have so much equity in their home now. If they got in trouble, they would just sell their home and walk away with a few $100,000. So again, you're not going to see those delinquency rates or foreclosure rates or forbearance rates go up. They're going to continue to go down. So let's get real about the market. We have low inventory, and the nicest homes are still getting multiple offers. And that's how it's going to be the next couple of years. So don't wait for interest rates to go down. The Federal Reserve is still jerking around on the interest rates. Before, it was a matter of, okay, well, let's lower inflation and we'll lower the interest rates. Well, the inflation is down to less than half what it was. Now they're talking about, unemployment is too low. That means people are going to be spending money, so we have to raise the interest rates. They can't figure it out. So expect the interest rates maybe to come down a little bit, but for the most part, we're going to be in that 6 to 7 range, maybe 5.5 it goes down to. So don't hesitate with purchasing a home, because I can tell you the real estate market is only going to continue to go up. It is now, and it has always been about the supply and demand, and that's not going to change. We have much more demand with the 30 million more people. The millennials are in their prime of their buying season, and we've literally built 6 to 7 million less homes in the last 15 years than we normally would have in an average going back to the 1980s. So again, don't hesitate buying a home. If you find a home, marry the home, like we'd say, date the rate. If rates do come down a little bit, then obviously go and refinance. But look at a lot of options: seller buy downs, adjustable rates, interest only. There's a lot more flavor out there as far as what you can do as far as financing. So as always, give us a call and we'll kind of guide you through it. But let's look at the graphs for this week. It's pretty steady. We're just coming out of Labor Day. This was the week before the Labor Day weekend. You can see in San Ramon, which is one of the hottest markets, actives and pendings have stayed about the same. Danville market, actives are down a little bit. Not a lot of people put their home on the market during Labor Day weekend, so obviously that market's pretty steady. Blackhawk market, inventory is actually down for the same reason I mentioned. Pendings are pretty steady. Alamo market, again, pretty steady. We'll see what happens in the next couple of weeks. Hopefully we'll start to see more inventory as maybe inventory builds up a little bit. But based on last year and a couple years ago, I doubt if we're going to see it. I think it's going to stay a really strong seller's market. Dublin market, active listings jumped way up, which is a good thing, because the Dublin market, if you remember, was one of the hottest markets out there. And look at the sold price, the list price percentage. Well, San Ramon and Dublin, which are the two hottest markets out there, are still 105 and 102%. You know, and Danville's been 100+%. We don't pay a lot of attention to Blackhawk and Alamo because sometimes, you know, their average prices are $3 million, $2.5 million, and there might just be one closing. So, but there's always 6, 8, 10, 15 closings in San Ramon, Danville, and Dublin. So that gives us a better across the board, and you can see that it's still running 100% plus because, again, those nicest homes that are selling are getting multiple offers. So again, this is a crazy market that we're in, one that I haven't seen for 45 years. Like I described last week, you have a situation where literally it's a tale of two markets. If a home's nice and priced well, it's getting multiple offers. If a home is not priced well and it doesn't show well, it's doing price reductions. I look at it and literally see price reductions and I see multiple offers. And normally it's either all bad or all good. Well, we have the tale of two markets because people aren't willing to pay 7% interest rate for that home that doesn't show well, that's overpriced. As always, if you want to be guided through, if you want us to be your trusted advisors or guiding you through this crazy real estate market, remember, in 45 years, I've sold through 7 recessions. They say we're going into another one, which we might be economically, but certainly not in the real estate market. Give me a call, Joe Kehrig, 925-487-6838, or drop me an email at joe@kehrigteam.com. Or visit our website, www.kehrigteam.com, to look at all of our listings and learn a little bit more about the Kehrig team. Thanks, have a great week, and we'll see you next week.